Hi, and welcome to the Midday Market Update for June 23rd, 2020. My name is Kevin Hill. As always, sitting here with Michael Vincent on our twice-weekly show that we do.
It is. Welcome,
the
everybody.
markets.
Welcome, everybody. And it's interactive, too, so get your comments and questions in on FreightWaves LinkedIn and on Facebook.
Yes.
And we'll get them answered.
Yeah, definitely.
And, we'll read your comments on air if they're appropriate.
Yeah, we love the questions and comments, and of course they have to be appropriate for us to read those. But we'll read those off and give out shout-outs to everyone viewing out at home.
Yeah, so we got a good show today, huh?
We have a great show today.
Who's on today?
We're going to start off with the news headlines, of course, with Andrew Cox, our research analyst. And then we're talking about the freight markets with Zach Strickland, our director of freight market intelligence here at FreightWaves. And then a little about the economy with our lead economist, Anthony Smith. And then we have Mr. Supply Chain joining us via Skype. That's Daniel Stanton.
Daniel Stanton, right.
Yeah, Daniel Stanton to talk about mini bids. It's something that we've been hearing quite a bit about, and we're gonna talk to Daniel Stanton about whether that's a good idea or if it's the most efficient process for shippers to engage in mini bids.
Yeah, because it's a change.
It is a change. It's going to be likely.
I think it's got a lot of pitfalls. I'll be interested to hear his opinion on that.
And then we're going to talk to John Flynn. He's the CEO of Fleet Advantage, talking about safer trucks with him. And then we'll wrap it up with some good news. But, it seems like we have some good news all around today anyway. Don't we, Michael?
We do. I mean, volumes are up, right?
Yeah, volumes are up.
I mean,
the freight market's healthy. It looks like the economy is
rebounding. Freight market's healthy. The economy seems pretty good right now for the moment. Air cargo rates coming down, that type of stuff. So
yeah, the emergency PPP or PPE. There's PPP, which is a bill with loans, and then PPE, which are face masks and things like that.
That's exactly right. Very good. You've learned something. Have you been watching our show?
I have, yes.
Excellent. Good job. Good job.
But first, let's talk about the state of the logistics industry that we have up. The 2020 State of Logistics Industry report is out, and Andrew Cox has those details.
Yeah, Kevin, in the 31st annual edition of the Council of Supply Chain Management for Professionals State of Logistics report, came out this week. The report painted a picture of an industry first traumatized by the coronavirus pandemic and the government's tough measures reported to stop its spread, but then able to right itself and meet the challenge of bringing essential goods to market. An industry that's rarely top of the public mind demonstrated an enduring value. The report said the sector, though damaged by the pandemic, is already adapting to the profound changes it has caused. The report also noted the report's central narrative echoed the views of many that the nation's supply chain, the logistics practitioners who support it, will shift from a model based on cost and efficiency to one driven by resiliency, defined by the report as being positioned as adjust and recover from future difficulties, which does really translate into rising warehouse demand. That's what the report noted. So warehousing, which had a banner year in 2019 due to the growth of e-commerce fulfillment, will continue to prosper in 2020 for two main reasons. Number one is that e-commerce demand has been soaring. This is something that we've noted, that e-commerce in the past 10 weeks grew almost as much as it had in the past 10 years, and that's going to persist after the pandemic. And then the second reason is the inventories are rising because businesses are now attempting to continue to keep higher stock safeties. So we saw this as an issue back in March and April, where stocks and inventories were completely depleted and they weren't able to get them back up and running quick enough. That's another focus for logistics practitioners. So U.S. inventories are projected to rise between 5 and 10% over the next few years, with each 5% bump translating to a 750 million square foot increase in logistics warehousing space needed. The surge in warehousing demand will keep availability tight, construction pipelines full, and rents elevated, the report said. It will also prolong the 8-year bull market into the sector. The report also notes that cold storage demand could be the strongest subsector as more and more consumers begin to buy food online.
So, Andrew, what did the report say about service transportation?
Yeah, Kevin, the U.S. surface transportation stepped back a little bit in 2019 after a really strong 2018. Motor freight demand in 2020 picked up solidly starting in May. We've seen that here on the outbound tender volume index, while the railroad's intermodal business remains flattish. Trucking may have a tough road ahead of it in the short term with more fleet cutbacks and bankruptcies, Zimmerman said. This will force shippers to engage in more conversations with their carriers while diversifying their routing guides. Mark Wallace, the Executive Vice President of Sales and Marketing at CSX Corp., said any near-term gains in intermodal will come from taking share from trucks rather than from growing the business organically. And on to air freight, they noted that air freight had a particularly bad year in 2019 with volumes down nearly 10% due to the slowing industrial activity. The mode then also took it on the chin during the pandemic as demand for non-essential goods collapsed and international passenger travel hit ground to a halt. Taking the lower deck cargo holds with them, international airlines desperate for revenue resorted to booking cargo aboard passenger cabins, in many cases removing the seats and lashing the cargo to the floorboards. The report noted that air cargo had a bright outlook because it's the most agile transport mode and tailor-made for a more resilient supply chains. Concerns about China were also scattered throughout the report. This, along with the confusing messaging we've seen out of the White House over the last couple days, truly the only thing certain about the U.S. and China trade is uncertainty moving forward.
Certainly is. It sounds like it's a pretty solid recap, and it's the type of things that we were living and reporting on a daily basis as we watched the numbers move and investigated what was going on through all of our various journalisms and research, et cetera, that was going on. But it sounds like some of the things that they're talking about there, Andrew, is really kind of the supply chain moving or a hybrid model. Remember we had the discussions between just in time and just in case. Will it change with that? So that safety stock level or that stock safety level and resiliency rather than cost and efficiency, yeah. Right, is the name of the game. And I think we saw that coming regardless, right? I mean, that's what we saw. We've been talking about.
Yeah, that's exactly what was in the report. And one of the major notes in there is that they focus a little bit more on 2020 than they normally do in the current year. It's more of a review. But 2020 has been such an outlier.
Yeah, I think it's reflective of the fact that seasonality is out the window right now.
Yeah, it's hard to go back and recap 2019 because the world has kind of shifted and changed, at least in the first half of 2020, and those changes will continue.
It absolutely is. There's a lot of different things that are inside here. We could talk about this thing really all day long with the air freight and what's going on with air freight. We'll talk about that. I think we've got another article about that.
Another article down
a little bit later. But even talking to what is going on with in surface transportation, just truck versus rail. Andrew, I mean, they're seeing that rail is down, and they'll see that they're going to have to take that from trucks in order to grow that. That doesn't sound like they're very confident at least in the rail sector and the economies that they would organically serve, right? Or are they talking more towards what we've been talking about, this volume surge that we're seeing in truckload? Will it start to dissipate and come down as that urgency starts to dry up, as they're seeing in air freight that we'll get into right now?
You're exactly right, yeah. On the trucking side, May trailer orders numbers came in. They weren't as bad as April, but I think they're still the second worst month in history. What do we have on that, Andrew?
Yeah, Kevin, you're exactly right. The new orders for May did come in. Alan Adler wrote this report. He noted that fleets ordered a little over 3,100 new trailers in May compared to a net of just 209 in April when an already softening market collided with the COVID-19 pandemic. This is all according to the research by ACT. The improvement was welcomed, of course, but the orders were still down 71% year over year in May. In April, almost all the new orders were offset by cancellation of existing orders. Here's a quote from Frank Malley of ACT Research. He said, although up from April's record low, May's net orders still rank the second weakest in history. And he continued to say there's little incentive for fleets to be investing in new equipment right now, so he sees a little bit of a tough road ahead for the OEMs.
So he's talking about May numbers.
Yes,
right. That's what
May order numbers. Yes.
70. Yeah. Okay. So he's talking about May numbers. I mean, it sounds a lot like a lot of the economic numbers that we've seen. They're just really just coming off of like historic lows and horrible numbers. A good single bump. But a single bump up doesn't make a positive trend yet. So hopefully that will continue and we'll see some more positive growth there.
And a couple of viewers here, Kenneth Carter says inventory rising is good news. We have a discussion going on in LinkedIn, actually, and Eric Williams, who's a lead logistics analyst at U.S. Foods, disagrees with that. Rising inventory suggests tepid sales. Not sure how that is good news, and I think it. Yeah, I think it really depends.
we'll let them discuss that.
Yeah, we'll
it
let them
depends on how you look at it, right?
It does.
That's
what kind
we've
of
been
context
walking
is
about.
around there, but oftentimes rising inventories is not good news. But in this recovery, we'll see what plays out.
We'll see what that is. I mean, we saw inventories deplete, and so rising inventories were good news because people are out of things and you couldn't find them, you couldn't restock, right? And we've seen, and there's a lot of evidence within the volume of truckload that we're seeing moving in the length of hauls in those markets that it's, origin, destination. The OD pairs of a lot of those volumes suggest movement of inventory from one place to another, which creates trucking jobs, but isn't really necessarily indicative of things being purchased. It is restocking, removing of inventory, and it's all timing. So,
and that would be a good question for Zach Strickland whenever he comes up. About those inventory levels. Let's move to the ocean, Andrew, and talk about ocean carriers and capacity and what they're doing with that.
Yeah, Kevin, China to West Coast rates are up 84% year over year, despite the pandemic bringing down some of that demand. The reason behind this current rate escalation is because all those blanked sailings that the carriers put out at unprecedented levels from Asia to the U.S. especially, and from Asia to Europe as well in the second quarter. They did this to try to balance out the vessel capacity due to the reduced demand. They were trying to keep their rates up, and they did a pretty good job of that. But as it turned out now, looking back over the last couple weeks, cargo demand exceeded the unblanked vessel supply, causing rates to rise, particularly from the Asia to the West Coast. According to the Freightos Daily Baltic Index, for this route specifically, it was up to almost $2,600 per 40-foot equivalent unit on Friday. And this over the 3 weeks prior to that, rates shot up almost 60%. They're now back up to where they were late in 2018 when we saw all of those U.S. shippers trying to front load the import cargoes to beat those tariff deadlines that were going in place at the beginning of 2019. Copenhagen-based Sea Intelligence introduced 2 scenario forecasts, which they see for the rest of the year. In the first one, carriers started pricing more in the second half of the year, and they see rates falling, with carriers losing about $7 billion. The second scenario is in which carriers keep rates high, keep them near current levels, and they actually pocket over $9 billion in profits. Tensions will inevitably escalate because of this. BCOs are in the midst of a recession and are paying higher transport costs as a result of the carrier's decision to artificially restrict capacity, with vessel capacity largely under the control of just 3 large global carrier alliances. Asked for a comment by FreightWaves National Retail Federation Vice President of Supply Chain and Customs Policy, Jonathan Gold, replied, "We remain very concerned about the ongoing issues that are impacting the carrier industry right now."
Yeah, I'm sure they are a little bit concerned. I think everybody's concerned about what is going on in the maritime industry right now. Will they get into a pricing war? Will they try and keep, as they say in the article, keeping the capacity artificially low? Because it isn't due to demand. The price has been going up, and if you look at the volumes into maritime volume of imports into the United States, they're nearing 2018, 2019 levels, if not crossing on certain days, going up. And all of them show upward signs, monthly, weekly, 2-weekly improvements on there, along with those rates. Capacity needs to come back online. You've got, like they said, it could really hurt the recovery and consumers when you have these manufacturers, et cetera, like they say, in recessionary times, trying to restart things and are paying exorbitant amounts of money for equivalent capacity than they were last year.
You're exactly right. And then you have some trade tensions that are coming out on a China-U.S. trade deal. There was some news last night where the Peter Navarro has said that the deal was completely off, and they're backtracking those comments right now. So I don't know where that stands this morning about those negotiations.
Yeah, it's very hard. We have an air cargo report too.
We do, yes. So what do we have in the air cargo world, Andrew?
Yeah, this one is from Eric Coolish, guys. He says the white knuckle ride through the air freight market stratosphere has ended as prices continued to fall back towards earth again last week, bringing relief to companies that purchase air transport to move their goods. The change in conditions is best illustrated by export flows from China to the U.S. and Europe, where air freight rates have tumbled more than 60%, from $15 or $20 per kilo at one point to under $10 per kilogram. Now, as panic buying for PPE equipment especially gives way to pre-planned ordering and supply chain shifting to accommodate other types of products. Meanwhile, importers are using air freight to move products that have become popular during the coronavirus quarantines. They highlight athleisure clothing, building supplies for home improvement projects, and office equipment. This is all according to logistics professionals talked to by FreightWaves.
Yeah, it was an interesting report, and some of the details behind that are still interesting. It's another one of those things, like we were talking about, a lesser degree of very terrible, right? Like the trailer orders, right? These prices coming down are still double and quadruple rates of where they normally would be, or where we've seen, historically in recent history where they were. So they're coming down, but not like, to normal levels.
No, then they're not, and they're in the article as well, they're shifting from PPE equipment to more consumer goods, which is a good thing, Yeah,
I found it interesting because they said that PPE less so on the air cargo because the supply the supply chain has really filled up those inventories, and the demand isn't as urgent as it was. It's not necessarily that the volumes of them in total are down, but they are for air cargo. They're moving towards maritime and slower forms of movement. They can live with the longer wait times, or the longer supply chain cycle with those. But people can't wait to get their hot tubs in athleisure wear.
Athleisure wear, yes. There's more about
growth.
that. People getting out and exercising more.
That's right.
Trying to fill their times. Going out less often as well.
Yeah.
So very interesting report. That was Eric Coolish, and that's on FreightWaves.com. All of the stories that we went through on our headlines can be found at FreightWaves.com. To learn more about those. But now we have our Director of Freight Market Intelligence, Zach Strickland, here to talk about trucking and freight. And what do we have today, Zach?
Yeah, Kevin. So we have, I guess, officially entered the start of the peak season, or I shouldn't say the start. We've been kind of ramping up for a while, but I guess some of the big points of contention have been around whether or not we're going to see the traditional seasonality that we see every year around this time, where we lead into July 4th with increasing volumes, increasing tender rejection rates, and that does appear to be the case, so far this year. We increased roughly 4.85% week over week in terms of the outbound tender volume index. So the volumes are on the rise, and they're on the rise relatively quickly, considering, we're about to enter this period of time where we traditionally see volumes kind of cool off a little bit in July, still elevated over, say, a January or February, but it is a big point to watch out for, just to see how rapidly things move in and out of peak season this year, for sure. On the same point, tender rejection rates jumping significantly this week. Now, they have accelerated far beyond what the tender volumes have, jumping about 300 basis points a week over week. So this time last week, we were right around 6%. Now we're over 9% tender rejection rate. That kind of increase in activity does indicate that we're going to probably see a lot more spot market activity here over the next week and a half, for sure.
Yeah, it's really interesting to see how it's really from Memorial Day on, we've been, the market, or the freight market has really been following seasonal trends. I mean, it's been pretty spot on. The question is, does it continue after this? What are you seeing in those volumes? Is there anything telling in those volumes, origins, destinations? The tender lead time is increasing, which you would imagine right now is a cause of tightening capacity in some of those major markets, because it is like, as Luke Velasco was saying earlier today, he pointed out that it was the top 10 major markets that are really pushing that, right?
Yeah, I mean, we're seeing that, a lot of the, tender rejection rates are increasing across the country. They're increasing a little bit more, unevenly. The volumes are indicating, yes, growth out on the West Coast, but a lot of the carriers, have kind of started becoming accustomed to this as they're repositioning out there. We're seeing a lot of volume growth in Atlanta, Dallas, Chicago even's jumped in on this. The middle of the country has really turned on last week. We talked about this a little bit in terms of tender rejection rate too, because capacity does appear to be suffering more disproportionately through the middle of the country as the volume growth is still occurring around some of those regional ports. Houston last week was a big one. Savannah has now joined the fray, if you will. Elizabeth, New Jersey, another big one up there around the port of New York, New Jersey. But again, a lot of DC activity up there. Ontario continues. Los Angeles and Ontario continue their torrid pace of growth, and all of them are contributing to the tender rejections increasing significantly. Now, something that is interesting to me is the fact that Ontario is growing, or the tender rejection rate is 12.3% out there on the West Coast. So this is an indication that, even though carriers have identified it, it's still leading the country in terms of the largest market in terms of capacity tightening. The next up would be, Denver or a Dallas. Dallas, for instance, has grown all the way up to 10.45%, and we're averaging right around 9.3% on the national. So some of these markets are definitely tighter than the national average. The Northwest and Southeast continues to be a lagger, both laggers in terms of capacity tightening significantly. Atlanta market is still right around, the Atlanta market is still around 8.24% on the tender rejection rate, whereas you have markets like Seattle at 2.7%. So not a big surprise there in terms of Seattle. So it's not happening everywhere in the same rate that you would expect.
That's very good. So Zach, let's switch gears a little bit and talk, focus in on the reefer market, and how's that going so far?
Yeah, reefer capacity still tightening as we speak. We are entering, the traditional peak of reefer season is between June 1st and July 1st. It continues, of course, to expand around that time period, but traditionally we see, especially around the produce season, most of that volume occur this time of year, and reefer rejection rates still significantly high. Some of the highest ones are in the Southwest, some of the same markets that we see that for the tightness, elsewhere for the dry van, but we're seeing Southwestern tender rejection rates for reefer being around 23%, so still quite significant. And the West Coast, again, about 22.5% in terms of reefer rejection rates. And, it's been a good produce season thus far. And it continues to be pretty strong. It's still nowhere near what we saw in 2017, 2018, when we saw a big expansion of both of those the spot rates there. We still have a nice week-over-week cadence going. You're seeing these, small 1 to 2% increases on the spot market for produce coming off the West Coast, but we're starting to see a lot more activity along the border. So the Mexican produce is starting to come in too more significantly, with the broccoli, carrots, things like that are starting to move across the border as well.
Great.
Excellent, Zach.
Yeah.
Thank you so much.
Yeah, thank you so much, Zach. And Zach Strickland, our Director of Freight Market Intelligence. And what do you make of that?
Well, it's on a daily basis. It's very, very useful right now, and it looks like things are very strong for the near term. Things are very, very strong, but they're fragmented, obviously. But I think you're getting contracted carriers, back into some more normalized type of patterns, which is correcting things. And now you're starting to see that OTRI kind of go out. I think you're seeing the tightening of capacity in those where it was before. Yeah.
Do you think? Do you think we see the same general seasonal pattern this year as we normally do?
Well, we have right now, and I think we will.
That continues into
I think we will. For a bit. For a bit, it will. It all depends on timing, man. You got the PPP about to run out. Yeah. You've got even on the carriers. So the moratorium on cancellation of policies due to not paying your premium, that's over. And so those are going to be called in. Is that going to reduce capacity even further? And where do the PPP? How does that actually play out, right? Because you've got a large percentage of the populations that is actually using that to survive, that aren't going back to work. Yes, there's consumer spending, and yes, a lot of people put it in the bank, and so did some corporations, et cetera. We saw savings go up and that sort of thing. But if unemployment remains high and stays there, and you start to see these defaults on loans like we saw on the small and mid carriers, Yeah, I think by late summer end of July, it's a completely different situation that we're talking about.
We'll just have to wait and see.
Yeah.
But let's talk about the housing market right now. The housing market remains strong, and Anthony Smith, our lead economist here at FreightWaves, is joining us to give us the insights on that. What do we have, Anthony?
Hey, Kevin. So when we're looking at housing, it's a bit of a tale of two different industries right now when we're looking at existing home sales and new home sales. Existing home sales, which is going to make up the bulk of the transactions, actually declined 9.7% in the last month and is down double digits on a year-over-year basis. But many economists that watch this industry closely for existing home sales are expecting this to rebound quite sharply in the summer months. When we look at new home sales, this is one that increased double digits, 16.6% on a month-over-month basis, and just over 12%, nearly 13%, 12.7% on a year-over-year basis. So this is one of the few macroeconomic segments that is showing a year-over-year growth rate right now. And looking at new home sales, again, new home sales a smaller portion of overall home transactions, but increased nonetheless. The big part is where consumers are going to fit in all of this. Right now, we have some consumers that have not been affected too much about this whole coronavirus pandemic. Many have been able to shelter in place, be at home, and kind of business as usual, but work remotely. So they haven't had too much of a disruption in their financial status. And so these are some of the individuals that are going to be able to make some headwind in the housing market. Now, again, there are millions of Americans that have been financially impacted by this COVID-19 pandemic, and those are Americans that are probably looking to be a little bit laxed in spending. And as with that spending, we've seen an increase, a very vast increase in deposits when it comes to financial institutions. A lot of Americans are depositing this additional money that's been sent out, whether it be the $1,200 stimulus check or the additional income that's coming in from these jobless claims or benefits coming in. So we're seeing a really kind of a big ramp up when we're looking at the overall spending or lack thereof. As you know, from last week's or previous week's editions of the Midday Market Update, we talked about the savings rate increasing quite substantially. So it's looking like there are really a tale of two different segments, those that are really hesitant right now in spending and really kind of just banking their money right now, and those who have been able to operate business as usual. So that's one of the big areas for housing, but one thing's for sure, the outlook and the outcome for housing is going to really be dictated by what's going to happen with this whole COVID-19. The longer the pandemic kind of lasts, the longer and the more drastic effects it's going to have on the overall economy, housing included, even though housing has been a little bit more resilient than some of the other sectors over the last few months.
On the bank deposits, do you have a sense of a bank's lending appetite? Do you think credit terms are becoming more restricted, or do you see those loosening up as the economy recovers?
I think banks are going to be a little bit more hesitant to just to lend out during a time of recession, but what this added deposits, one thing's for sure, is that they're likely going to be a little bit more lenient on bringing down some of these interest rates, which are already at pretty historic lows. So I think a lot of these banks, again, are going to be a little bit hesitant to loan out money during the recession, but I think those interest rates will surely start to kind of come down in due time. And that's going to really kind of play into what consumers are going to do with this additional income. It's one thing for it to be kind of influenced into or put into the economy, but if there's not a lot of transactions happening, this money is just going to kind of sit around until the consumers feel confident enough to kind of start spending their money again once they start to feel a little bit more secure in their financial future.
Thank you very much for those insights, those economic insights. Anthony Smith, our lead economist here at FreightWaves. And
Yeah, it's very interesting, and I think that
it's interesting.
The difference between existing home sales being down, 9.7%, I think he said, and then new home sales and construction starts and permits are up, right? Mm-hmm. Is that indicative of the move of society from city center to
more outlier areas, suburban and rural areas?
Yeah.
It could be. It could be that new construction in, what do they used to call it, exurbia? Kind of beyond suburbia?
Beyond suburbia.
Beyond suburbia. So a little bit longer drives into work, but it looks like a lot of people won't have to drive as much going forward. Certainly probably not five days a week. There would probably be a lot of people who work just a couple 3 days in the office, but that's another trend that we're watching very closely here. And
is it work days and weeks, but also the population in city centers much less popular, obviously, right now, right?
Yes.
Would that have something to do with new sales over existing? I would think, right?
I would think so.
That would be an indicator.
I definitely would. We have our next guest coming up right now via Skype, and that is Daniel Stanton, a.k.a. Mr. Supply Chain. How are you doing today?
Chain.
Doing great, gentlemen. I'm doing great. How are you?
We're doing great. We are doing great as well.
Hey, happy to have you on, Daniel. I heard you had all the answers today. You have all the answers for us today.
I just wanted to, put a little bit of color about Anthony's analysis there. I think the increase in new home sales is in Chattanooga to support the incredible growth of FreightWaves. And that just moves the needle for the whole economy. So
I think you may be right on that, Daniel. I do, definitely. So this comes from a LinkedIn post that you posted, I think, on Friday about mini bids, because we were talking a little bit about mini bids. We've been hearing that shippers are going more into mini bids to capture those low spot rates over the last few weeks. And you had some really good questions on kind of how good of a strategy that is, really. Really, it is.
And I think it's really interesting. We're seeing so many things that are kind of like standard playbook, standard operating procedure having to be modified because of COVID. And my guess is some of these things are innovations that are really just temporary, right? It's a stopgap. It's a Band-Aid that's going to get us through a time of a lot of uncertainty. Some of these might actually be things that change the way that we do business, create a new paradigm, right? To use the fancy business term. And so I'm looking at all of the different business practices and trying to figure out, hey, is that really just a better way to do it? Or is it a Band-Aid? And frankly, is it even useful, right? Who does it provide value for? And I think that the mini bids that you were talking about are a really interesting example. Because the way that this normally works for shippers is, about once a year, they go through, they look at all the volume on their lanes, what they're projecting for the year ahead. There's a ton of analysis involved in that. And then they try to divide up that network into packages, right? Because it's generally better to bid out a package of lanes rather than doing every lane one at a time. There's a bunch of fancy software. There are consultants that you pay to help do this. And then you end up with contracts that at best are good for a year, and only if the market doesn't change a lot, because if there's a big shift in the market, you're back to spot anyway. And so on the one hand, I get, the argument that, listen, there's so much uncertainty. We don't want to commit to 12 months. We just kind of want to do 3 months. But on the other hand, you're like, for the level of effort that's involved to try and do this every 3 months, both for the shippers, right, to put that bid package together, and for the 3PLs to do a response, does that added cost actually generate any value? Or do you just look at it and say, listen, the market is the market, and we should be using the spot rate and figuring out how we can get the best spot rate by maybe tendering our loads with a little bit more lead time so we get a better price on them?
You're exactly right. To do a mini bid is the same amount of time and resources for all the parties, shippers, 3PLs, and large or carriers as well, right? Just because you do a mini bid doesn't mean that it takes less time and effort and analysis and resources from your company. It's basically you're doing the same work as doing a yearly bid.
Yeah.
And it might be good for 2 or 3 months. And what we're finding out in the freight markets right now is that everything's on an uptick again. So those mini bids that you've been, I know it's all changed by the time you actually enact these mini bids.
That's right.
Yeah, the name of it is what is confusing. Mini bid. It's not a small little bid. It's still your whole bid, but for a shorter period of time, which doesn't make it it's a more difficult bid is maybe what we should call it, or the inefficient bid. I don't know. I like your concept though of talking about, because it's kind of one of those comments or questions that is there's no stupid questions, right? Why aren't you just playing in the spot market? Why isn't it just more based off of the spot market? And in the past, that could lead to very volatile type of things. But you've got instruments, freight futures, to be able to hedge, and both parties could hedge very, very effectively and set a line plus or minus the daily assessed price on closing cost on each day. You index them towards the different futures, and you don't have to go through these bids, and everybody gets a fair price. Is that not correct?
No, I think that's right. I mean, at the end of the day, it's about efficiency, right? I mean, it's a market that's driven by supply and demand. We know that, we talk broadly about transportation, but we're really talking about U.S. truckload transportation in this conversation specifically. Right. That is a very I'll say open market, right? I mean, even the huge players in that have very little control over the total market share. And so what you would expect is the more efficient you can make buy-sell transactions, the better alignment you're going to have between price and value. I'll say it that way. And one of the things, what I see as a big disruptor in that space is, the electronic load boards, right? The electronic load matching and whatever flavor, whatever terminology different companies want to put on it, but you're automating the buy and the sell. Well, that increases efficiency, that reduces the cost. That should get us closer to a true alignment, right? And kind of maximizing the value. And that, in my analysis right now, that could be the thing that kills bids, right? Mm-hmm. Now, that you just say there's whether it's 3 months or 12 months, at the end of the day, transportation is a variable cost. We want to get that cost as low as we can by maximizing efficiency. Electronic load boards are probably an instrument to get there. The competition between the load boards helps to ensure that there's, prices get pushed down. And then there are ways to play in the load board to make sure that you're getting the lowest price. For example, tendering loads at the right time, right? Because anything that you tender at the last minute, you're going to pay through the nose for. But if you can sort of do it in advance, maybe that's how you get the best value.
Yeah, it's all about getting that, take the stock market, getting that bid-ask spread as narrow as possible. Yeah,
that's right.
So you mentioned on your LinkedIn post some research. You cited some research from MIT about a decade ago. Can you fill us in on a little bit more about what they found on mini bids and efficiencies?
Absolutely. Two of my classmates at the MIT Center for Transportation and Logistics, and who are now, one of them's a muckety-muck at XPO, and the other one's a big shot at Apple. But what they were looking at specifically was when you tender stuff to the spot market, when do you get, what impact does timing have on prices? And basically what they found looking at the data at that time was, if I remember, like if you tender 7 days out, that saves you $50 a load, right? And if you're a big shipper, right, $50 a load across, all of your lanes is a big deal. And so I think that's a good example of saying, that it could really be about sort of like feeding back changes into your business process, right? Mm-hmm. And that becomes really a supply chain issue. right? When in the process do we place orders? When do we tender loads? So that we can, it's not about, cheating the other guy and saving a buck here. It's really about sustainable solutions that maximize the value that a supply chain creates by minimizing the cost for everybody.
Yeah, and as a freight broker, I could tell you on the floor, it does matter what time of day and day of the week
absolutely it does.
you tender, and the difference could be between having an ulcer and not having an ulcer. If you timed it right, you don't have an ulcer. If you don't time it right, you're going to get an ulcer because there's a lot of pain points in there.
The other piece that I would throw into that is, that really becomes a data game, right? That becomes a number or Moneyball sort of approach to supply chain and logistics. And this is where I think FreightWaves becomes a game changer. And you guys mentioned the freight futures, right? If the data is available now, you can start to understand those decisions that you need to make. And to the extent that there's uncertainty, you can use freight futures to hedge so that you get stability in your costs.
You're exactly right. The Moneyball analogy is very good in finding those timings within just really the lane. You have the lane data, lane rate, but those timings when you actually tender that load, it makes a huge difference.
It makes a huge difference. A same-day tender versus a 3-day tender versus a 7-day tender. There's
and 300 miles tendering on Thursday. Or Friday for a weekend, it affects the price. I mean, you're going to pay double the price than if you did a day or two early, and that driver is able to do the weekend haul, right? That long haul weekend makes absolutely a great amount of differences.
Yep, absolutely do.
No, and the key is, with the data that you guys are providing now. It goes from being sort of a tribal knowledge intuition sort of decision to data-based, fact-driven business planning.
Mm-hmm. You're exactly right. Well, thank you very much, Mr. Supply Chain. How do our viewers reach out and contact you?
Please follow me on LinkedIn or on Twitter. I'm Mr. Supply Chain at Twitter. So thanks, guys.
They pick up your book, Supply Chain for Dummies, correct?
Supply Chain Management for Dummies, number one bestseller on Amazon.
Perfect.
Pleasure having you. Keep in touch.
Thanks.
Definitely.
Take care, guys. Talk to you later.
Thank you. Always great talking to Mr. Supply Chain.
I love to. I like to hear his thoughts. It's interesting that he said that innovation, competition, and transparency are what's going to fix things.
Exactly right.
Who'd have thought?
I know. Our next guest is joining us now, and that's John Flynn, the CEO of Fleet Advantage. How are you doing today, John?
Hey, how's everyone doing there? I'm just doing fine, thank you.
Doing great, John. Nice to have you on the show. Thanks for coming on.
Appreciate it.
Yeah,
Appreciate the opportunity.
You bet. And we had an article out yesterday, Alan Adler, about safer trucks. Could you explain that a little bit in more detail for our viewers?
Sure. We looked at what's been happening over the years, and especially a severe accident in New York many years ago, 4 years ago, that prompted us to look into safety further. And we tend to look at safety in a holistic way as we look at the whole cost of ownership and the whole cost of trucking and the whole process. And what we determined in the last 2 or 3 years of looking at it was the safety equipment will more than pay for itself over a relatively short period of time. And there's a lot of gain to be made in the aftermarket when you have equipment 4 or 5 years from now that has safer equipment on it. The insurance rates are going up and many other things that are impacting the values in the aftermarket, and safety is one of them.
Excellent, solid point. So, John, just for our viewers' sake and so on, to get context around this, can you give a little bit about what it is, that Fleet Advantage does, and then from the safety, what are you guys doing specifically to address that safety, and how are you guys actually contributing to that?
Well, we're a huge proponent of shorter cycles on the truck use, meaning the initial user. A lot of people do what we relatively relate to as functional obsolescence. Can you buy a truck and run it 10 years? Absolutely you can. But is it cost effective? No, it's not. What we've determined is it's far more cost effective to rotate the trucks out somewhere in the vicinity of 400,000 miles, give or take a little bit, in 4 years. We've got a database of over 55,000 vehicles reporting monthly, and we have about 18 billion miles of data that supports both the fuel economy, the maintenance, repair, accident damage, and various other aspects of it. What we do is go into companies that are using traditional methods, which are sweating their trucks is what we refer to as running them too long. We go in and give them a fleet modernization plan that shows them how they can not only upgrade their equipment to safer equipment, they can upgrade it to more efficient equipment and fuel, get better driver satisfaction and retention, and actually do it at a lower cost than they're spending now.
Great, John. What are some of the safety equipment that you have right now that's available to owners of trucks?
We started including about 3 years ago, I believe it was, 2 to 3 years ago, disc brakes all around instead of standard brakes, collision avoidance including emergency braking, lane departure, and then blind spot assistance. And there's some other things we're looking at now with cameras, but it's a little too early to make a determination on that. And we've seen accident rates go down. We've seen collision costs or repairs go down. We've seen this as a huge impact in every fleet we operate with.
We talk about insurance quite a bit at FreightWaves and on the Midday Market update. What kind of cost savings on the insurance bill and the ease of actually getting insurance are involved into these safety procedures and equipments that you guys offer?
Well, I'm not sure if I understand. Is it the insurance you're asking about, or is it the cost of the equipment?
The cost of insurance.
The insurance costs, in our case, we lease to mostly large private fleets. We have 25 of the top 100 fleets in the country, and most of them are self-insured. But we do look at the aftermarket. A lot of our equipment at 4 and 5 years goes to owner-operators and smaller companies that either don't run enough miles to justify getting a new piece of equipment, or simply don't have the creditworthiness of balance sheet to support same. And they need good equipment. Instead of buying 6- and 7-year-old equipment that's going to be high to maintain and costly to maintain, they get a nice 4-year-old kind of pedigree truck from us that came out of a good operation with good safety equipment. Does that answer your question?
It does, yes.
It absolutely does. And John, you talked about the obsolescence or when people should be trading in trucks because of the maintenance costs. The maintenance cost side of it, running it for 10 years, as you said, you absolutely can, but you're paying through the nose for those last, 6 years or whatever it is, depending on your safety program and how well you do it. But even with the best, I guess, maintenance program, even with the best maintenance, there's that law of diminishing returns, and it just gets too expensive to maintain it. It's cheaper to buy a new truck. Is the same true with safety equipment? Is there a number of years are recommended to trade out the truck because of safety reasons beyond just the maintenance costs?
I think we don't know the answer to that quite yet. And the reason I say it is that safety technology is moving so rapidly. I mean, look what's happened in the last 3 to 4 years. 4 years ago, this safety equipment I just mentioned to you wasn't available. I mean, if it was available in certain OEMs and not in others. As of 2021 model years, which is as of this current year, 2020 calendar year, those items I mentioned to you are standard now by all the manufacturers. In fact, if you don't want them, you've got to delete them from the standard list. And I wouldn't want to be in a situation sometime in the future having an accident and have someone looking over my decisions and what I made on specifications for safety, find out that I deleted certain things.
Yeah, exactly.
Yeah. Hey, John, in the article from yesterday, talked a little bit about the Buylease program. Could you explain that a little bit more for us?
Yeah, what we're doing to help promote it is, of course, everyone's looking for cash and conservation of cash. I don't care how big the company is. They're drawing down credit lines, credit facilities. One of the things we offer is to go in and do a fleet modernization program, under which we'll go ahead and buy all their equipment or just their equipment that's, say, 4 years and older. We launched it about 5 weeks ago. We've already done $17 million for the business with it, 150 trucks. What we do is we go in and buy out the used equipment they have, and then they can either shed some of that equipment if it's surplus, which in fact some is surplus equipment in today's economy. We'll get rid of it for them. They can release the equipment from us at usually a cost that's lower than the depreciation, because we're taking a residual value on the equipment at some point in time, and the depreciation is usually to zero. And then as we progress with them, we'll frame up a fleet modernization plan right from the onset, meaning at 6 months we should insert X percentage of the fleet and change it up to new equipment. And essentially, it's a cost-driven decision. I mean, we've got all the data analytics we need out of their own information. We take their maintenance and repair software, we get their onboard computer downloads for telematics of what they're doing for fuel economy and mileages. We're able to tell them pretty much right to the penny what it's costing them for each model year. And it's surprising how much of a enlightening it is to them to see the fleet study that we do for them.
Yeah, it's excellent. You mentioned the telematics for the maintenance and the cost and that type of thing. Do you look at telematics data for the safety part of it as well? As you consider that a strong safety feature, having those telematics to be able to view the driving habits?
Yes, there is. I mean, it shows you hard braking incidents. It shows you jackrabbit starts. It shows you a number of different things. And that's going to be more and more in the future as well. As this technology is fascinating to me. I mean, they're working toward, as you well know, toward the autonomous truck. Yeah. And the process of doing that, they're making steps every year. In fact, probably 3 or 4 times a year. And they're inserting certain connections into the trucks that could be used later to direct retrofit. Unfortunately, when you look at older trucks, if you go back to 2017 and older, those trucks cannot be retrofitted, if you will, for things like collision mitigation.
What do you see Oh, go ahead.
There's a few people that have done it, but it's costly.
Got it.
What do you see the biggest technology trends that you'll see in trucks, or that we'll all see in trucks? They're mostly aftermarket or in new manufacturing that will assist drivers in the next, say, 3 to 5 years.
Well, what we consider that surprises me actually is they still continue to get better fuel economy. I mean, the GHG mandate went into place in 2010, and the first leg of that mandate was 8 years, and they anticipated they get a 2.5% compounded annual rate of increase in fuel economy, which I read it, wanted to believe it, but didn't believe that would really happen. To be candid, I was a little skeptical. However, the data has concluded that it did happen. In fact, it's gone beyond that. Now, the GHG2 that went into effect about 3 to 4 years ago is actually moving at about 3% per year. It's one of the reasons we mentioned a shorter life cycle. If you run 100,000 miles per year, and this is based on $3 a gallon, which is a little high for today's market, but at $3 a gallon, every 4 years you're going to gain about a mile per gallon. That's about $300 to $400 per month that you're saving in fuel economy. And our lease rates are only $1,500 to $1,700 a month. So the fuel itself is subsidizing the cost of exchanging the equipment for new.
You're exactly right.
It's a good sales pitch.
It is. It is. Thank you very much for joining us today, John. How does our audience reach out to Fleet Advantage and learn more?
Best way is to go to our website. It's fleetadvantage.com, and we'd appreciate anyone calling in that would like to check through our website and contact any one of us.
Great, outstanding. Thank you again, John Flynn with Fleet Advantage.
Thank you, John.
Yes.
Have a great day.
You too.
Very interesting stuff.
Yes.
It really is. I mean, the innovations that are going into the trucks, it's amazing. And him breaking down the fuel economy and so on, and how it's been improving and improving and improving.
Yeah. You can see that in cars too. I mean,
absolutely.
All these incremental improvements trying to get to full autonomy are making cars, trucks, the roadways much, much safer. Collision avoidance, lane checking. All of these great. You can actually have cars that actually park for you now.
Yeah, you absolutely do. Yeah. And I mean, with the telematics and the cameras and so on and so forth that are in the vehicle, that's got to be incredibly valuable data, not only to safety teams for training, et cetera, but the development of automated vehicles, right? To learn exactly how humans are responding to specific situations and which ones turn out with a positive outcome and which ones turn out with a negative outcome. But then all the underlying maintenance data that you can get out of it. This type of driving causes these type of issues, et cetera, et cetera. It's really it is fascinating. I agree with John Flynn. It's something that you kind of look at and go, it's kind of It really is fascinating. It really is.
It is. It is. So that's really good news. Let's wrap up the show today with some other good news. So what do we have,
to
Michael?
go already?
We're getting close.
Okay, some other good news. So what's good? So let's see here. What's good? On the trucker, CDJ Bulk Express allows its drivers to customize their trucks, and they pay for it. They pay for it. You know those purple lights you got under your car that make it look? They would pay for that if you did it. One of their drivers, a veteran trucker named Robert Morris, was seeking out new ideas of how to decorate his new truck when he looked to his wife's work for inspiration. She's a special education daycare worker who teaches autistic students. That spawned the idea for Fiona. Yep. It is that Fiona.
It is, yes.
Shrek's wife in the Shrek series is wrapped in autism awareness signature puzzle pieces and has been a conversation starter over the road with the other truckers whose lives have been impacted by autism. So Fiona's his truck, and it's wrapped in these puzzle pieces for autism to bring awareness to autism. Part of Fiona's message is, don't judge a kid off what you think you know. Every kid is unique, and every family has unique challenges, Morris said. And so CDJ Bulk Express actually pays for those drivers to do those things. I imagine there's some criteria like that, right?
There probably is, and that's a much better way to customize your truck than mud flaps and the purple lights, the running boards.
Depends on your cause.
I guess it does. It certainly does. Josh Holbrook he's a new business development guy at Buchanan Hauling. Talking about the mini bids, I believe. I work at a mid-sized brokerage, and our daily coverage orders have bounced back to early 2020 levels. So that's more on the freight market.
Oh yeah, so his
update,
overall, you've seen it come up there. That's nice.
That's good. Yeah, that's a good thing for the economy.
Good to hear.
Yeah,
another good data point checking in right there.
It is. So what do we have for this week on FreightWaves TV?
Tell me. What have you got coming up? You've got some stuff coming up.
Yeah, so at 2 o'clock today, about an hour after we wrap right here, we have Great Quarter Guys. We're going to talk about housing, the economy, three different topics to take a pulse on what's happening in consumer spending and housing. So that's what we're going to do at 2 o'clock.
Great.
At 12 p.m., tomorrow, Eastern Time, put that coffee down. We're going to talk about selling a new product or service and the challenges that go along with that. We'll have a guest on from Hub Tech to discuss. They have a new product out, so we will discuss the challenges
of selling vaporware for a while until you get a product going.
Exactly right.
I know it pretty well. I know
educating
that. I've been
the market,
in that space before.
getting that out. I think you definitely have some experience in selling a new product, right?
Yeah, I do.
And then Wednesday at 4 p.m. we have With Sonar with Luke and Kyle talking about sonar and the freight markets. And then we're back here at 12 p.m. Thursday, Eastern Standard Time, where we'll do another midday market update. And then at 4 p.m. after that, is it the best show on FreightWaves? It's your most favorite, I think. Is Freight Forecasting with Michael Vincent. And what will you guys be doing?
We're gonna look at post 4th of July summer season.
Yeah,
that's what we're going to look at. We're going to look at what are the indicators showing. Where do we think things are going to move? Where's it going to settle down at? Is it going to continue to show the same seasonality? How are things going to play out? Because right now it's kind of showing that at very elevated levels, but can it sustain there and will it continue? Where are there going to be those hiccups? Yep. Everybody, staggered start to the economy. Where are things lining up for that? We're deep enough into it. We should be able to start having some sense of direction of what to expect over the next couple months.
And then Friday we have What the Truck again. We had it Monday. You can find that on tv.freightwaves.com or Freightcast everywhere. Friday will be another
epic
exciting,
show.
Epic show. What did you guys do yesterday?
We went around the world of freight with Cass Index volumes, highlighted some trucking's heroes, talked about cargo theft and insurance, right? And the curious case of the containerized cocaine. You remember the ship they found in Phil? That was incredibly interesting.
Yes.
It was incredibly.
Did you mention Kaiser Sose? during that segment,
No,
didn't you?
I didn't know if anybody would catch that. I made that reference,
I did.
And I don't know. But I mean, it is kind of that way. There was a mention in the article that caused some death threats that had to change part of. And
There was,
so
yes.
it's,
There
it's
was,
a
yeah.
serious situation.
It was very
situation.
serious. Yeah, we had to alter that just because of those death threats. So that was troubling, just to say the least. But yeah, Friday with the truck, but that wraps it up for this episode of Midday Market Update. Take care.
Good afternoon. Peace and love, everyone.